Hello, and I welcome you to today's weekly market outlook here together with Admiral Markets. My name is Jens Klatt, and yeah, I welcome you to today's webinar. So we have plenty of things to discuss, in fact, after the developments of the last days. Some very interesting price action, in fact, happening in the FX markets that happened especially over the last days. In pound sterling, for example. Where we heard that Theresa May will step down as UK Prime Minister on the 7th of June after some, I think we can fairly call it devastating defeats she faced around her Brexit deal. And we will surely have a look at this since right now, for example, in pound sterling against the US dollar, one might say, especially after the price action over the last days, okay, well then, probably we are about to see some further losses in pound sterling against the US dollar. This, yeah, is naturally the first reaction. Unfortunately, the US dollar currently sees some heavier selling too due to a collapse in 10-year yields. And the question here is, how is this to be explained? And especially when looking at the still quite solid performance of equity markets. And yeah, so, but before we start, as usual, we have to have a look at the risk disclaimer and then take it from there. So first of all, trading with financial instruments offered by Admiral Markets carry a high level of risk, which is not suitable for all investors due to their complex nature. And before entering into a client agreement or making a transaction, please make sure that you read the terms and the conditions of the service from Admiral Markets. These were just the first 2-3 sentences of this risk disclaimer. The whole risk disclaimer can be found on the website from admiralmarkets.com. Yeah, for further information, please have a look at the website then. Nevertheless, we want to dig a little deeper into the differentiation now between retail clients and professional clients. As usual, when it comes to the ESMA decision, it went already in effect in August 2018, but still we want to have at least a short look at it and what differentiations now take place. So now retail clients have a leverage restriction of 1 to 30 in Forex majors. This is, for example, Euro USD or dollar JPY, and 1 to 20 in other currency pairs. Just let me give an example, like Australian dollar against the CAD, for example. There it's 1 to 20, and 1 to 20 is also the applicable leverage for CFDs then, like the German index, the DAX 30, or gold, for example. And again, now, yes, there is a differentiation. And where is the differentiation coming into play? Now, the leverage restriction we already mentioned. This is not true for professional clients. So if you meet certain criteria here, you can be recategorized as a professional client. For further information, which criteria has to be met, everything, please check the website from Admiral Markets, and then also feel free to contact the customer support for further information. If you think you meet those criteria, ask what you can do to then apply for such a professionalization. The thing is, it's very interesting for some traders that there is, when you're categorized as a retail client, an unlimited protection against negative balances. This is the standard when you are categorized as a retail client after ESMA. Interesting enough now, professional clients, when trading with Admiral Markets, they not only have a no leverage restriction, but also, according to the policy from Admiral Markets, they have a negative balance protection up to £50,000 according to the policy. Also here, feel free for further information to reach out to Admiral Markets. Yeah, this is me, the face to the voice you're currently listening to. Then the question, why Admiral Markets? So regarding my person, probably only one small thing, not the whole life story I want to present here, but I'm located in Berlin, in Germany. Admiral Markets, by the way, has also an office here in Berlin in Germany. And what I can tell you from experiences from several talks with traders, professional traders also, they say, well, we all agree on that Admiral Markets can definitely be considered to be one of the most competitive CFD brokers, and especially regards to the offering of the DAX with the typical spread of 0.8 points here during the main trading hours. Also with the offering from Admiral Prime, you have the chance to get a spread of 0.2 and then get a commission added on top here. Interesting about this offering is, for example, that it's very interesting for scalpers, so very short-term oriented traders. On top of that, also the FX offering is very, very competitive, and yeah, so this is the view from German traders, which is probably also applicable then to other traders around the globe, where Admiral has several offices. So it's not only Berlin, but Admiral Markets is, for example, also registered and regulated here, authorized by the FCA in Great Britain, in the UK. Also, for example, registered then in Australia, for example, there it's Admiral Markets Pty Limited, which holds an Australian financial services license. And also for further information on the regulations, what this could mean for your trading, from wherever you want to open an account, feel free to reach out to your respective customer support, Admiral Markets customer support. There are the contact details. And then we want to have a look at our agenda. I already mentioned some aspects. What are the key economic events in the coming week of trading? Something we definitely want to have a look at. What's special, in fact, is that next Monday is a very thin market environment to be expected. Reason for that is that we have a bank holiday in the US. It's the so-called Memorial Day, which results in shortened trading hours here. Where this is true for not only gold, for example, or precious metals in general, commodities, but also for the equity markets there. So the Dow Jones, for example, or also the S&P, they have shortened trading hours, and it's also something which is interesting or noteworthy for us here in Europe, for example, because we can expect slow start into the week, even though German index, the DAX 30, is not affected. Still, we shouldn't expect high volatility to come. Probably see some spikes around the market opening, but strong trends shouldn't necessarily develop here then on Monday. Still, there are some other events we want to have a look at here, not only from an economic, but also from a political perspective. Then surely we want to answer the question, what's the current bias in FX, equity, and commodity markets? Probably also give an idea, not only around the political developments in Great Britain right now, but also have a look at the upcoming election in the European Union of the weekend, and what this current tendency to probably get how can we say, get a very conservative result here out of this election, respectively, probably a right-wing tendency, what this could have as an effect on the FX markets, especially on the euro, and surely which trading opportunities may arise. And then we switch over to the charts and have a look here at, in this case, gold, but probably makes sense to have a look at the DAX first here. So the DAX is about to go for an attempt to break above the current daily highs. I'm really sorry, this is a little unfortunate. So I haven't updated the chart for quite a while. So I updated several charts, but not this one. Let me just give you an idea of what I'm currently looking at and why I consider this region to be really interesting. So this is the region around 12,070 points. So just to let you know, I looked at this region already yesterday when preparing today's trading. After the drop below 12,000 points, the potential main driver for this push lower, and then for the DAX pushing as low as 11,920 points, is most likely to be found in still elevated fears, at least, that the trade war between the Chinese and the US is about to escalate. Especially on Monday, we started out very weak here and saw some heavier selling that came with the fact that the US banned, in fact, or put Huawei, the big telecommunication company in China, put it on a blacklisted it, and that was, by the way, already 1 week ago, so last Friday. Some of you probably recall that I mentioned it during our last weekly market outlook when I said that we probably shouldn't underestimate the impact this could have on markets. And in fact, on Monday, then news hit the wire where it was said that Google stopped providing Huawei with Android updates, and it's not because they wanted to do that, because and I think this is something we should definitely believe here. I think they had a very, very good business relationship, and they still have a good business relationship with Huawei at Google, but still they are bending towards the pressure built from the especially U.S. administration and U.S. President Trump, and so that resulted in fears that the next level of escalation is reached here, and this next escalation level is reached. And now the thing is that fears rose. So far, nothing happened, but still, this is something to keep in mind for the days to come. The thing is that the Chinese are probably willing to not only cut any ties here when it comes to the US in regards to delivering rare earth, for example, to the US, but also to some extent probably ban Apple iPhones in the US then, and punishing Apple here, even though that from this perspective probably doesn't make sense, in fact, and they're not really keen to do that, but still this is something they could take into account, and we shouldn't forget about the fact that Apple has around 10% in the NASDAQ 100 here. So, or put it differently, so if Apple shares, for example, drop 10%, this has an impact of -1% on the NASDAQ alone. And we are not taking into account any spillover effects on other telecommunication providers, and the technological sector and everything. So this is definitely something to keep in mind when we're looking at the current developments. And yeah, so yesterday the situation and fears arose from anew, and then pushed the DAX below 12,000 points. Interesting enough, we didn't went straight through and tested 11,800 points here, but stopped around 11,900 and are now seeing a pullback and testing former lows, the lows in fact here from Monday. Oh, I'm sorry, it's not Monday, it's Wednesday. It was Wednesday. So we started out the week here on Monday. That was where we started and where we saw the push lower. We in fact overran already the lows from Monday. That was a first potential short trigger around 12,020 points here. And yeah, I'm now about to test these lows here. And I have to say, I'm not really sure if there's enough selling pressure forming potentially against this region, with the outlook that today's day is the last before and potential prolongated weekend. So what I'm talking about is that on Monday, again, we have shortened trading hours, we have the Memorial Day, we have in fact a market environment which should be expected to be really thin, not very volatile. And in such an environment, usually you see, especially in such a current mode here, where the market is already drifting higher, we see just a continuation of this drift higher. And so I'm not really seeing a big push lower in US equities for today, which means nothing more than we should probably really careful here with shorting the DAX against this region and expect a push lower. I mean, still it's a possibility, please don't get me wrong, but something to keep in mind here when aggressively considering this is a short trigger. Could also imagine that the market probably just drifts higher and we are about to completely make back all the losses from yesterday, probably close the week significantly around 12,000, above 12,000 points and around 12,100 points or something. So short is definitely something, or short positions should definitely be taken with a grain of salt. And on the other hand, we have to keep in mind that still tensions are high when it comes to the current situation. around China and the US. And also on top of that, we have the election here. We have the election in the EU over the weekend, and so far we can already spot that there's a tendency that, as I already mentioned at the introduction of this webinar, that there is there is a potential positive result for the conservatives, respectively, for the right-wing parties. Not only here in Germany, so in Germany, the party is called AfD. It's the Alternative for Germany, or Alternative für Deutschland. But also in Italy, we have the Liga, which is currently also in the government with Salvini. We have in France, we have the Front National with Marine Le Pen. We also see some very strong polls right now and results here, potential results for the Brexit party in the UK, Nigel Farage. So there you can already feel that probably Britons are happy to see Theresa May now resigning on the 7th of June. Still, the thing is, many market participants already expect such a result. Plus, on top of that, we have to remember that last weekend there was a video published then, which referred to Austria, and there the FPOE and their leader Strache, is not anymore because he's also resigned, but he was the vice chancellor of Austria, and it's also a right-wing party. And the question now is somehow how big is the impact, negative impact, on the conservatives / right-wing parties based on these results out of the developments in Austria on the other right-wing conservative parties in the Eurozone. And so my take is that if it has no impact at all, this could potentially be bearish. One thing to remember is surely that when talking about politics and then potential impact on markets, that usually markets have short legs, we say. So that means nothing more that any impulse we get to see on the upside or on the downside is not necessarily a sustainable one. But still, there's, in my opinion, with such a bad result for the euro in general, and a good result for Eurosceptics. This is most likely be something, especially in the current environment, with all the Brexit uncertainties, with the uncertainties around the trade war between China and the US. It's potentially something which is negative. On the other hand, if the impact of these developments from Austria are good enough to somehow leave the right-wing and conservative parties to a subdued election result, let's say. If this happens, then on the other hand, we have to get this, or we are probably seeing a positive impact on equities and potentially a push higher, especially in such a thin environment as we have it on Monday, thanks to the US bank holiday and the Memorial Day here. So with this in mind, that's in fact everything I have to say around the DAX. We can also here have a look at the DAX on a daily time frame. There you can see that we are still trading above this blue line, which is the simple moving average 200. And also we are trading above 11,800 points. I have to say, as long as we trade above that level, the overall mode stays choppy sideways or neutral here, but still with a bullish touch. And we have another chance to push towards 12,400 points in the week to come, especially as long as we trade above this simple moving average 200, respectively, the 11,800 region. And in fact, that's it. That's it on the DAX. And let's then switch over to the currency markets, which are probably a little more interesting. And by the way, I've just have something here, something which you can already see in the Guardian, for example. Theresa May has announced a resignation. Nothing which I haven't already said here. In fact, that's from Twitter. It's probably of higher interest is, first of all, let's have a look here at the economic calendar on the website, admiralmarkets.com. And there at the top, you can find it yourself here, analytics, and then the Forex calendar. And there you can filter it. And I've now here displayed the numbers from today, the 24th of May, till next week, Friday. What you can already see here, durable goods obviously are a number which will be released in around an hour from now. I don't think it's such a big driver. I don't think that even if numbers disappoint, it will result in a further push lower in the US dollar, or respectively, if numbers come in better than expected, I don't really see a positive impact on the US dollar. And this is in fact also true for all other events which are published next week. So we can see this is the last week of May, and usually into the end of the month, the economic events thin out, in this case, dramatically, if you want. And the first really important news events will then be released with the beginning of June again. So all in all, this is just to give you an overview of which events to expect, even though all events which will be published next week and also today might not really have such a huge impact on the markets, on FX markets, respectively volatility in general. So yeah, from here we can then switch over to this one here, which is probably the basis, the fundament here of the developments we've seen yesterday. So I was kind of surprised, in fact, to see the euro being so weak yesterday already. It's not that I wasn't skeptical about the euro before, but still it came as a surprise to see this stronger trend develop, especially in this low volatility market environment, and the attack and push towards and slightly below new yearly lows around 111 here. And it was mainly initiated then most likely due to skepticism arising from the Euro bulls among the election, probably. That's the only driver I saw, in fact. But then the market sharply reversed, and yesterday we pushed then not only sharply back from 111 and stabilized above that level, but we pushed back towards 112 here, and currently not seeing any demand for the US dollar. One likely reason for that is that yesterday there was a number being published that was the US manufacturing sector new orders index came in contraction territory below 50 for the first time since August. So all in all, numbers yesterday were, yeah, they were below expectations. I think it would be too much to say they were okay, since they disappointed quite big, in my opinion. Still, there is resulting out of that now fears that probably the US, especially when it comes to the expectation and developments, expectations around the developments in regards to the trade war, the market participants start to become really skeptical, potentially skeptical about the US economy probably. And this is probably also true to some extent after the Fed minutes were released on Wednesday already, and it's said the same as Jay Powell said, that the Fed, the statement signaled it, that the Fed does not see any need or is in no rush to change interest rates, and they emphasized it's true for both directions. So they're not really willing to hike rates, but on the other hand, they don't see any reason to cut it right now. And so that said, aggressively countering the calls here from the Trump administration, who somehow tries to force the Fed to talk the Fed into a rate cut here. Nevertheless, market participants are obviously very skeptical about this rhetoric, and they are still seeing, and this is something you can clearly spot then in the so-called Fed Watch tool. I just want to probably open it here. I just opened the tab now. Opens there. Beautiful. Works. So the Fed Watch tool, even though the rhetoric is quite clear that there's no cut or hike seen from the Fed, market participants are clearly expecting such a step then by December with around 70% rate cut in this case, which is probably explaining the current mixed performance of the US dollar. Let me just click here on the Fed watch tool. And here December, there you can see it. Now it's 75%. This is wow. This is really. Yesterday we had 30%. So we're dropping and dropping and dropping. Market participants are more and more and more aggressive in regards to rate cut, which is probably then now explaining where this push lower in US 10-year yields, Treasury notes, came from yesterday. So we made new yearly lows. Let me just, 1 second. Let me just show you the development over 1 year here. So you can clearly spot that we dropped to new yearly lows yesterday, and this is most likely then the driver for the move in the US dollar lower, which is yeah, the main reason, potential main reason where this sharp reaction in the other direction came from. And so yeah, with this in mind, the picture didn't significantly change, even though I have to say, as long as we trade in Euro USD on a daily chart, as long as we trade here below 112.60, some probably might say everything below 130.30 here, the overall picture stays bearish, and the target on the downside stays around 109, 109.50 probably. Euro skeptics probably will say there is a gap open here. You can probably have difficulties to see it, but there is a gap higher that's from April 2017. It's only, by the way, it's not really significant, but it's only as an orientation on the downside. If you're wondering, okay, what targets to look at on the downside if we do not hold above 110, probably this gap will be closed then. It's by the way, the latest sharper reaction to an election over a weekend. That was France 2017, when Macron won over Marine Le Pen in the election back then. What's probably interesting, a personal anecdote in this context, it's that we had, or I had a discussion back then. I don't really remember it, but a friend of mine just reminded me. He said, well, you're kind of yeah, you were really good in talk, or in anticipating what to expect in France. He said that I said back then that the developments in France are probably only short-lived, and I mean the yellow vest developments in France itself already show that Macron has big trouble from a political perspective, as being recognized as a political leader who is really capable of making a change and making a big impact with this policy. And I said that probably it's only now 4 years, and then we'll see an astonishing win from the right wing, respectively Euro-critical party, the Front National and Marine Le Pen. And we're probably about to get to see exactly that now with just a delay. And the first step now is the European election, and then we have the next election in around 1 year, no, 2 years. I'm sorry, it's 2019. And this is definitely something to probably remember in this context. Has nothing to do with the trading developments here, but in this context here on the downside, the target can, in my opinion, clearly be found around 107, then 108. It's 108. That this has a gap close and this work as an orientation on the downside if we get to see further losses in the euro against the US dollar. On the other hand, surely I have to say, again, there's the same argumentation as I already presented in regards to the DAX. With the developments in Austria especially, probably the market participants say if the if it's only a subdued result, and they are currently painting a very dark picture for the euro based on the political developments, and I'm probably seeing now right-wing conservative parties not gaining as much momentum in these elections after the developments in Austria. This is also something which could result in a short euro rally, in fact, and probably then the euro USD is especially interesting due to the weakness in the US dollar, but the same is probably also true for euro GBP. And we presented in the morning technical analysis on this with an outlook on the political developments in UK, but also in Euro, in Euro area, in Europe. What we saw here was in fact 14 days in a row where the Euro gained against pound sterling, and this is especially astonishing when looking at the fact that the Euro can clearly be considered weak in the current environment. So there's enough uncertainty left here, and only the sharp drop in US yields was capable to push the Euro USD higher and avoid a sharper drop below 111 yesterday. And still the Euro performed extraordinarily well over the last 2-3 weeks, in fact, against pound sterling, not only holding above 84.70, but also pushing above 86.80 here, and now going for another quite significant region around 88.30, 88.50. And now with knowing about the resignation of Theresa May after the EU election, with knowing about the political developments, especially when it comes to the Brexit party around Nigel Farage here, and the potential positive result he can expect from the election, I have to say that probably pound sterling will see another round of weakness today, only for one reason, stabilizing. First of all, the market looks a little exhausted after this push, and also on top of that, retail sales numbers, which came in the morning, were solid. Let's say they were okay. It's not that they were outstanding, but at least it's taking short-term pressure from the pound sterling and taking the wind out of those market participants profiting from this tailwind, probably we can call it, who are seeing the Bank of England probably to be forced to cut rates in the near term. Yeah, that way helping to stabilize here pound sterling a little, even though it may be short-lived, and especially if a short squeeze happens, if the EU election now over the weekend doesn't show such a strong victory for the right-wing conservatives, this could then result in a push higher on Euro GBP, leaving the pair capable of probably a strong trend up to, or move up to 91. And continue with this strong move here on the upside. So, and yeah, that's it on Euro GBP. Then let's probably finally have a look here at GBP USD. Also here, I have to say it's very difficult to now see one currency being favored over the other. Okay, 1 second. So I really don't see enough momentum, pound sterling taking out enough momentum for a push back towards and probably above 128.70 on the one hand, given mainly the aspects I just made clear several minutes ago. On the other hand, I have to say, even if we are capable of moving towards and against 128, 128.70 probably, see pound sterling, then finding a potential short trigger, I don't want to be aggressively long the US dollar given the current developments and given the current drop in US yields, which is also, by the way, surprising when looking then, probably let's switch back again to US equities. I think it's very difficult to make sense of this move because, I mean, yes, sure, we've seen yesterday a push lower, but it wasn't necessarily a push, let's say, below 2,800 points and significant momentum on the downside here. So I don't really see a potential risk of moving, which justifies such a strong demand for USTs yesterday and a push that lower in yields. So that somehow comes as a surprise and is something worth mentioning. So probably there's another driver in the background. Probably really it's fundamental developments which are currently only speculated, if at all, around the very dovish Fed then at their June meeting probably, which is currently driving yields lower. Probably they will announce something in direction of a potential rate hike. Deserve a next, it's not a strong U-turn in this case, but still a complete different and very dovish rhetoric after especially the Fed minutes now showed that there's no need for a rate hike, respectively rate cut, and a move in both directions. probably, yeah, probably this is currently the reason why equities can stabilize, and why this move comes as a surprise. Because again, usually you see such a drop of something like 8 to 9 basis points, which we've seen yesterday. You don't see such a move in a market environment which is still, I think, can be considered neutral. The picture starts to really darken the S&P 500 if we drop below 2,800 points. Everything above that, it's still solid, let's say, and it's again not really justifying such a potential risk-off move here in USTs, which we have seen yesterday. So USTs yields. If we talk about that, well, sure. First of all, we have to have a look at another currency pair and then switch over to gold. So yesterday we pushed significantly back above. I'm sorry, back below, not above, below 110 in dollar JPY. So far, the picture hasn't changed here too, but once we make it below 109, I think dollar JPY has a good and solid chance to see further push lower. On the other hand, we have to say, as long as there's no real risk off happening, and I'd say today chances are very low due to the bank holiday on Monday, and Monday itself also. We shouldn't probably await such a move, such a significant push lower before Tuesday, respectively, probably in the second half of next week, because the overall circumstances are not very favorable for JPY, which is usually funding currencies for carry trades, and in an environment which is thinning out and where liquidity is comparable low, respectively, where we have a bank holiday. Usually the JPY is not a currency to be favored. So, but it's a currency you want to buy, or you expect to be bought, due to an unwinding of carry trades in an uncertain market environment with higher volatility. And again, this is nothing you should expect with the Memorial Day then on Monday happening. And with this in mind, such a move below 109 seems very, very unlikely right now, but it's still on the agenda and should be taken into account here. And yeah, with this said, we also have an idea of my view for gold in this context, even though I still have to say I'm still not very, I don't know what to say. I'm not really sure what to make out of price action, let's say, over the last days, weeks, and in this case. So we can clearly say that the region around 1,266 USD can be considered considered a crucial region. So still also for this head shoulder formation. So you can see here that the push higher didn't bring us back above 1,310 USD, which means nothing more that from pure technical perspective, the head shoulder formation is still in play. Still, the thing is that you probably don't want to anticipate in this current market environment a break lower, since there's enough uncertainty, especially now around Huawei and the next escalation of the trade war, next escalation in regards to at least the rhetoric used, especially from Donald Trump in tweets against China, which is capable of which is potentially capable of pushing gold higher due to a risk-off move. While on the other hand, we have to say there's also some, probably a slight chance that things are at least stabilizing a little, and that this could then push gold lower, and we go for a stint towards 1,266 USD here, which is most likely then also, or not most likely, but it's a move you probably expect in an environment where yields are not dropping any further, but at least stabilize a little. And then we know about the negative correlation between U.S. yields here and gold in this context. But still, you can obviously spot in the words I'm using or the way I present it, I'm really not sure in which direction the next move will be. And so far, and as long as we trade below 1,310 USD, I have to say that I consider then I consider the short term, the short side to be favored, 1,310. But if I want to trade a break lower, I have to wait for 1,266 to be broken. Now the thing is, if you trade the break and sell with a sell stop here of 1,266, the stop you have to place has to be placed probably above this former high here, which was marked last week. No, it was the week before. It's nearly 2 weeks ago. Was it last week? 1 second, please. Oh yes, it was yesterday. It was last week. Last week we pushed towards this region here, but still, it doesn't matter. It's around 37, something like 40 USD per ounce risk we are facing here. And now the interesting thing about it is, if we project the target on the downside, we come out around 1,235 to 1,240 USD, which means we are probably seeing a chance of 25 to 30 USD per ounce here. And there you can see the risk reward is less than 1, which is not very attractive for a short trade here, which means you have to somehow be creative a little, let's say. And therefore, for example, I'd go down to another time frame, like probably the hourly chart, also something we can take into account here. So and then wait for a push to this region. Let me probably do it that way. 1 second. Let me just do it that way. I'll work it that way. So we have to wait for such a push lower, and then we wait for the market. If it really happens, it has to be awaited, surely, but nevertheless, we wait for several more tests of this region, and then we trade the break short, and we wait in this context that such a descending triangle works out. Why do I say that? Let me just probably explain this here. So such a descending triangle usually looks the following. So you have, 1 second, let me just use this one here. So you have such a structure, and the idea behind this is that you see a test of a support region for several times, but then the market is not bouncing back aggressively enough to overcome former highs, which were marked here. So this is the first bounce, then it comes the second bounce, and the third bounce. And this is something which points to a diminishing demand against the lows. And if such a structure develops, then you can say, okay, I trade the break directly short. I have a clear formulated target on the downside around 1,235. And I can work with a quite tight stop here at the former highs, wherever this might be, but probably it's somewhere around 1,270 or something, 272. And then you have only a risk of 4 to 6 USD while going for a target of 30 USD on the downside, which leaves you with a risk reward which is significantly better than 1. So you're using the higher time frame for the projected target, and then you use the lower time frame for entering the trade. But this is something we definitely have to wait for, and we have to be patient for. And on top of that, it is something which has to develop here. But this is something, or this is the only way I see the break of this crucial line around 1,266 to be tradable from a risk reward perspective. On a daily chart, I think it's not really attractive, and we should be really, really careful with that. Yeah, and in fact, that's it from my end. I just hope that I gave you an idea of what to expect then in the days to come. If you're watching here from the US, then happy Memorial Day. And we talk again next week on the 31st of May then, already with an outlook on the non-farm payrolls to be expected the week then after, and what potential impacts could be awaited then. And yeah, so that's it from my end. I wish you a nice weekend. All the best from Berlin, Germany, and happy trading. Watch your stops. Talk to you again next week. I look forward to it. See you, and bye-bye.